Welcome to International Finance. Welcome to International Finance. This is our first class. I think we should have had a class last week, but we were in any case just going to go through assignment number 1, right? Of which I think we can reserve that for our next lesson. We can pretty much do that, start on that on the next lesson. So the advantage with us having to go through assignment 1, which is the multiple choice questions, is in the process we get to talk about quite a lot of other things that surround this module. You see, so it basically gives you an overview of what we will be doing, as opposed to the stuff that we're doing like today, which is just focused on the first topic, which is the South African balance of payments, right? I think if you do have the learning unit number 1, or if you have your study guide, I think you should be able to see this. But the notes that I gave you, I don't think they would tally much with what's given there. So this is something that I researched for myself, based also on the past exam questions. So we are basically answering a question here, right? Or a couple of questions as we are going through this topic in particular. All right, so I think you should know by now that if we are dealing with international finance, international basically means something that is beyond our borders, something that is not domestic. So, which is basically our interaction with the rest of the world, right? Our interaction with the rest of the world. So, where is that interaction recorded? That interaction is going to be recorded in what we call the balance of payments, which is what we are dealing with today. Our transactions, or the transactions between a country and the rest of the world over a specific period, which is typically going to be a year, right? So that basically is your definition of your balance of payments. So this module is very much related to international trade, and I think it's an easier version of international trade, but we will see how we progress, right? Right. So generally speaking, this balance of payments is going to have a couple of divisions, which I've put up there, and then the last one being the unrecorded items there. So we'll just go through what we expect to get there on the balance of payments. So a typical question that you could be answering from this, if you have gone through past exam questions, a very common question would be describe what are the components of the South African balance of payments. So you are basically describing what you expect to find there on the South African balance of payments, so that you can get also on the study guide, like I said, right? So you are basically listing and giving a description of each and every one of those terms there. So the first one on our list here is the current account, right? The first one here on our list is the current account. So the current account basically measures the flow of goods and services, income, and current transfers between a country and the rest of the world, right? So which is in this case between South Africa. So it will obviously include the following goods. So these are physical goods. So which is the exports and the imports of goods. So this is what you get there, the exports and the imports of goods. That's where they are recorded. So in our particular, if you look on the study guide, you will see that obviously you should know that your exports minus your imports basically gives you your trade balance, right? Basically gives you your trade balance. So with us here, we have a special, okay, ours doesn't specifically give us a trade balance, right? We actually have to look for those amounts. You basically look for the merchandise that is imported, and then the merchandise that is exported, and then you find the difference between the two to give you a trade balance. That's one feature that you would find within the South African balance of payments, particularly the trade, particularly the current account, under the current account, where you want to find the balance of trade. And then the other thing, exports of gold, that one also has a specific line for it, based on the fact that our country was very big on exports of gold. It was built on gold, basically. Everything around our country was centered around gold. So because it's an important thing, we therefore felt that we should have the gold net exports as a separate line item there. So that's the difference that you get there. So even though it is part of your goods, right, your physical merchandise, but it has a separate line there. That's what you get there. So those are the two distinguishing factors between, or the two distinguishing items between the South African balance of, particularly your trade in the current account, right, your trade balance, and then with that of other countries. That's the difference there. So you are merely looking at goods here, and I'm sure you know that we are most of the time not running a surplus, right? We are most of the time on a trade deficit. And then, of course, services. So these kind of services are going to include tourism, financial services, and consulting, etc. Quite a number of things. So these are the services that we are selling to external, or let me not say external parties, selling to the rest of the world and buying from the rest of the world. So these are going to be recorded here as services. All right. So an example of a service, let's take, for instance, I'm doing tutoring services. I could be tutoring someone who's, I think last year in this class, we actually had someone from, what's this country in Europe? I can't remember. But this was someone that was originally in South Africa, starting with UNIS, and then they migrated there. So this is just as good as we are exporting services from here. So it would pretty much fall under our services there. And then with incomes, we are dealing with dividends, interest, and profit. So suppose you have invested abroad, or somebody has invested here, you really have to pay dividends or get dividends out of our investment. Sometimes it could be money that you have put in the bank, in a foreign bank, or money that they've put here, and they're expecting to be getting interest from that. So that will pretty much fall under this here, right? That would basically fall under this here. And then current transfers. These are one-way transfers of money, such as remittances from South African workers abroad, official aid, and grants. So this is something that could either be coming from us to other countries abroad, or the other way around, right? So such kind of aid, I think the United States is very big on this kind of foreign aid. So that would fall under our current transfers there. And then next up there, we have the capital account. So on the capital account, we are tracking now capital transfers and the acquisition and disposal of non-produced and non-financial assets. So it's worth noting that capital account is often not a significant component, right? This one is often not a significant component. So you are looking at something that is similar to what you find on current transfers there, but except that you are dealing with capital items, right? You are dealing with capital items. So in those circumstances, those kind of things are going to be recorded on the capital account, right? And then the financial account, which is very, very, very important here, the financial account. This one records changes in ownership of financial assets between countries and the rest of the world. So here we are talking about direct investment, portfolio investments, and other types of investments. So you typically get 3 of those there, right? I think there's an addition now. I can't remember. It could be derivatives. It could be derivatives, but I don't think it's still, we are on this here. An addition in terms of as a separate line item, right? They've simply put that up there. I believe it's derivatives. I'll have to recheck the notes I did last year. I think they contained derivatives there. right? But what is direct investment? So direct investment here, you are looking at a certain degree or level of influence that you want to exercise in a company. So which is high. So you're looking at ownership stake here, a huge stake, something that's say above 10% can pretty much fall under direct investment. This is when you're looking at huge companies, of course. So we'll refer to that as foreign direct investment when it's coming into the country. Right? So this is something every time we wanna talk of investment, attracting investors, these are the kind of investors that we want, direct investment. Right? So obviously it comes in many different ways. It could be through the JSE. Sometimes, you could come from abroad and then you start up a company, right? That still falls under direct investment, right? Because you are talking about significant ownership stake then. So in terms of accounting, anything that is over 10% is considered to be significant. You are almost running the company if you have 10% stake of these publicly traded companies, right? But most important, you want to differentiate between direct investment and portfolio investment. We need to draw a distinction between those two. So portfolio investments, now we are dealing with financial assets such as stocks and bonds, but these are more on the short term and don't involve a degree of control or very large control, significant control in the invested entity. So under portfolio investments, you are basically, what's the word that I'm looking for? You are as good as someone who's betting on the stock market. So you're not really invested. You're just betting on the stock market. It's short term. So you're pretty much buying and selling those shares, right? Buying and selling those shares. You're looking at bonds, right? You're looking at bonds. So those are going to fall under that. So anything that is not significant ownership is usually going to fall under your portfolio investments there, right? That's where you expect to get that, right? So whenever you're making a description on the BOP and you're talking of the financial account, then you want to point out the difference between these two. Obviously, this direct investment is preferred to the portfolio investments because these portfolio investments, it's very fickle, right? It comes and goes, and it can be destabilizing also, right? It can really be destabilizing on the stock market. I don't know if you guys know about this, but sometimes big organizations, big companies can actually trade against certain companies. Say maybe you could trade against a company that's in the JSE. For instance, if you are holding a number of shares in that company, you can all of a sudden sell those shares, right? You can all of a sudden sell those shares. It will drive the price of that stock down, right? So you're as good as betting against that company. But this here is very unpredictable. This is more predictable. Direct investment is more predictable and more helpful in the economy of a country, right? And then on other investments, then you're looking at any other thing that doesn't fall on those there. So which is various financial transactions such as loans, trade credits, and other financial instruments. Right? Those ones can come under those. As long as it's not recorded there, then it's gonna fall under other. Right. And then the last item there would be our unrecorded item. So because it's a balance of payments. Okay, am I breaking up too much? I think somebody is complaining that I am breaking. Brit, is it getting better? Is it improving? Please unmute yourself. Unmute yourself and then let me know how it's going on your side. If you're not shy to unmute your mic. And I should have put a disclaimer. Oh, I think I did. I think before you joined, I'm in load shedding, so it's probably my side. I apologize for that. But please, yeah.
No, it's fine. I can hear you properly now.
But it's better. Sorry about that.
Yeah, it's much better than before.
All right, that's fine. Please, anytime, if you can't hear my voice, if you need me to repeat anything, just unmute yourself and say, right?
Okay.
Perfect. Okay, so now we are on the unrecorded item. So I was still saying, because this is a balance of payments, at the end of the day, we have debits and credits on a balance of payments. So whenever we are receiving money, we record that as a credit. We refer to that as credit. And then when we have to make a payment, we refer to that as a debit. So at the end of the day, this has to balance, right? Because it's the balance of payment. So in terms of, in the accounting sense, this has to balance. All your debits will always equal all your credits, right? But because we are dealing with very large numbers here, and we are dealing with a lot of accounts, a lot of things that we need to take into consideration, it's likely that it's not going to balance. But in principle now, because it has to balance, then we need to put in the unrecorded items. So this is more like the balancing items to make sure that your credits are always equal to your debits, right? So we need to put that there. And I think the one other thing that I forgot to put up there was the reserves, right? Was the official reserves, which are kept in the, but we will talk about that again, which are kept in the South African Reserve Bank. So which is normally going to be your reserves of your foreign currency and your reserves of your gold, right? So, but most importantly now, the unrecorded items on the balance of payments are transactions that are not officially recorded. So this can happen for a variety of reasons, such as some of these transactions could be illegal or unreported, right? And then some of these transactions are difficult to track. And then, of course, unrecorded items do make it difficult to get an accurate picture of the balance of payments, but it's not a big problem, right? It's not a big problem because at the end of the day, we do get to have an understanding of where the country is going, right? We basically know whether we have a surplus on the current account or financial account, so we get to see all those things. So I think I'm gonna resend other notes after this, where I think I really have to include the reserves, right? I'm just gonna put them up on the next set of notes that I'm gonna send. And then some of the specific items that obviously do fall into this unrecorded category is going to be illegal activities, underreporting. So businesses and individuals may underreport their imports and exports in order to evade tax. So this is very common, especially in Africa, right? In fact, all over the world, it is very common. Unscrupulous business people. Sometimes there could be barter transactions. How do you even report those? Informal cross-border trade, right? So it's not obviously going through the formal channels, so we will not know what that constitutes, right? So because we say it now, so the unrecorded items basically force the balance of payments to balance, right? It's going to balance because it has to balance in the accounting sense. But the fact that the balance of payment balances doesn't mean that there are no balance of payment problems, right? There are going to be balance of payment problems. And then where do those problems come from? So a balance of payment problems is basically when there's an imbalance in your balance of payments that will cause a problem. That will definitely cause a problem in the balance of payments. So such an imbalance can come from your current account or it can come from your financial account. So what sort of imbalances are those? So whenever, for instance, on the current account, for it to balance, your exports need to be equal to your imports. That's where there is a balance, right? When that happens. So whenever there's an upset there, then we refer to those as that's going to fall under your balance of payment problem. So the question is, that's the balance of payment. Balance is in the accounting sense. Does not mean that there are no balance of payment problems. That's what the question would be. So what are those problems? This is what we are tackling here. The problems that are associated with the balance of payment. So it can either be a surplus or a deficit. So we are going to start off with the surplus here, and we'll deal with the current account. So a surplus is going to occur when the exports of goods and services and incomes exceed the imports, right? So remember again, in these categories here, when you are dealing with exports of goods, services, etc., here on exports, they could be imports of goods, right? We're talking about imports of goods, and then services, you can also import services. And then with incomes, when you're looking at dividends, etc., interest, there can be an outflow there, right? An outflow more than an inflow. So that is going to lead to, so whenever this one here, your exports, which is the money that you're getting, the credits here that you're getting there are more than the debits on the imports, then that's going to result in a surplus in your current account, right? So what are the problems associated with that? Problem number one, currency appreciation. So a persistent current account surplus can lead to an appreciation of the country's currency. So this can make exports more expensive for other countries, potentially reducing export competitiveness and harming industries that rely heavily on exports. All right, how does this happen? I'll be brief on that. So the result of this here, people buying or foreigners buying quite a lot of our commodities, services, and incomes is going to lead to a demand in our currency. So that increased demand in our currency can lead to, or will most likely lead to, a currency appreciation, which is going to work negatively now, right, in terms of harming our exports. You see, so our exports are basically going to become, so once our currency is strong, I think we'll be dealing with this quite a lot much later. Once our currency is strong, then our export market is going to be suffering. All right. And then again, there's a likelihood that where there's a situation where there's a surplus, there's going to be a dependence in the foreign demand, right? So it might suggest that the country is relying heavily on foreign demand for its products and services. So what happens now when the global demand decreases for one reason or the other, right? For instance, there could be disruptions in, not so long ago, I think flights were banned, foreign flights were banned, and we couldn't even easily import and export, right? I think you remember that time in 2020 where exports and imports were restricted, heavily restricted because of COVID. So what happens if, as a country, you are heavily reliant on foreign demand? So you are going to have a problem. Your local companies are going to have a problem. So this is opposed to a situation where I think here we are quite lucky because we have, in terms of exports, I think we do have a very big domestic market here. So if you look at countries like South Africa, if you look at countries like Nigeria, look at China, if you look at the United States, there's a huge population. There's in the United Kingdom, there's a huge population. So though not to say that trading, foreign trade is bad, but at the end of the day, we must also have domestic trade to supplement foreign trade, right? So such countries obviously do survive under those circumstances. And then the loss of domestic demand. So to maintain a current account surplus, a country needs to restrain domestic consumption. So this we're going to be dealing with again much later. There was a little bit of peace on the assignment, right? But one way in which domestic consumption can be restrained could be through fiscal policies, right? The fiscal policy where maybe we might increase our taxes, we might increase the taxes on people just so we can lower domestic demand just to, to cause people not to import a lot, because we want a current account surplus, right? So we want to take money out of people's pockets using the fiscal policy so that people don't buy a lot from abroad. So you'll notice that such a thing or such a policy is not going to affect exports, right? Because exports originate from out of the country, so we don't have direct control of that. But by limiting our imports and maintaining the exports at one level, we can basically have a current account surplus there. So obviously, I need not to mention the effects of the loss of domestic demand that can potentially slow down the economy, definitely, and lead to unemployment. Imbalanced growth, right? The focus on achieving a current account. So sometimes a current account surplus is something that is deliberate. Countries do that deliberately, right? But again, of course, it's going to lead to an imbalanced economic growth. So resources might be disproportionately allocated to export-oriented industries and neglecting sectors that cater for domestic consumption and investment, right? So I think here we'll be discussing policies such as maybe, giving these export industries subsidies and the like. So you find that those that industry is going to grow, but other industries are going to be struggling. See, so this is what we are referring to there as an imbalanced growth. So all that, imagine doing all that merely to achieve the current account surplus. You see, and then again, reactions from trading partners. So persistent surpluses can lead to tensions with trading partners. A very classic example here is China and US, right? The trade war. I think you must have seen that about a year or two ago. So I think it got so intense that the United States in particular, I don't know, it wasn't in retaliation or whatever, but the United States actually, okay, it was in retaliation. They banned certain softwares from operating in phones like the Huawei, right? I think if you have seen that, if you've gotten your hand around the Huawei, you've seen that I think Google is not operating so well, especially on the latest versions. You see, so those are negative reactions from trading partners because China is always maintaining a trade surplus. You see, so it is assumed that it's at the expense of countries like the United States. You see, so now some of these reactions can also come in the form of, embargoes, putting in tariffs, etc. So those are negative reactions towards that. So it's gonna obviously, have a very bad consequences. All right. So not only can we have a surplus in the current account, we can also have a surplus in the capital account, right? Which is the financial account that we are referring to here. So with the capital account, okay, it was formerly known as the capital account, which is what we know now as the financial account. It was formerly known as the capital account. So in some textbooks, probably the textbook that we are using, I believe they are going to classify it as capital account. Right. So under what circumstances do we have a surplus there? It occurs when there is more capital inflows from foreign sources than we are sending out. What's the effect? Currency instability, of course. A large influx of foreign capital can lead to rapid currency appreciation. So that is similar to that other currency instability that we spoke about on the current account. So it leads to currency appreciation, right? Sometimes it could be unplanned for. So remember, the effect of this currency appreciation, particularly when it's rapid, it's definitely going to hurt our exports and our imports. You see. So we don't want that. Anything that comes too fast is a red flag, right? Asset bubbles. Asset bubbles, these are very notorious. These are very notorious. They can actually bring down an economy, right? So the excess capital inflow can lead to speculative bubbles in the real estate, stock markets, and other assets. So if you research and look at the, I think 2007 financial crisis, I think it must have come from the asset bubbles in the United States. So it could be caused by this. So it's a speculative bubble. So if a lot of people are buying stock, right? Say a lot of people are buying stock in South Africa. What happens to the price of the stock? It keeps going up, keeps going up. So the more the price goes up, we start to speculate that the price is going to keep going up. Right. So even you didn't want to buy shares, but your friend tells you that last week the share was 100 rand. This week it has gone up to 200 rand. I've made 100% gain on this. So even you now, you want to invest in that. So you keep investing. So, but at the end of the day now, this can't go on forever, right? The price can't keep going up through the roof forever. It has to come down, right? So when it comes down, it's going to cause financial instability and economic downturns. For instance, the value of a company is based primarily on its assets, right? On its asset base, I would say. But on the stock market, it's not the case. On the stock market, you basically trade. Trading is what determines the value of the company. So there will end up being a situation where the value on the stock market is just way too bigger than the value or the asset base of the company. And then once investors, get back to their minds, they start selling, the stock, and then there's gonna be a rapid drop in the price. So if every price is dropping in the market, then this bubble is basically bursting. You see, so people are going to be very, very poor, right? And then of course dependence on foreign capital. So this is right where we are. This is right where we are as African countries. We depend quite a lot on foreign investors. You see, we depend quite a lot on foreign investors, and we are very much vulnerable. Right? So most of the time, when a country is running a trade deficit like South Africa, it's going to be compensated by a trade surplus. So we normally have a financial account surplus. So we have a financial account surplus most of the time. But the problem with that now is a high dependence on foreign capital. So when we start fighting with these countries now, you see how strained our relations were not so long ago with the United States. So this is definitely going to affect the financial market. You see, definitely going to affect that part there, because those are our biggest sources of capital. Those are our biggest sources of capital. So if you wanna know who runs the JSE, if you wanna take a list and see who runs the JSE, most of those companies are foreign owned. You see, most of the monies. Cyril Ramaphosa is always wants this kind of investment, right? But the problem is too much dependence on that makes us very vulnerable as a country. You see, so you can't really make decisions now, without taking into consideration what they think. So if they withdraw their money all of a sudden, what's the effect of that? The effect of that is going to be the same as when an asset bubble is bursting. You see, suppose we have decided that we are supporting Russia, for instance. We are supporting Russia, and the market makers are not happy. The providers of capital are not happy. They decide to withdraw their money from the country. So which means the value of JSE is basically going to collapse. You see, so which is also linked to loss of economic control. So this is pretty much the same thing there. You see, debt concern. So while capital surplus might initially boost investment, it could also lead to excessive borrowing. So if these investments do not generate sufficient returns, the country might struggle with servicing its debt in the future. So this should be easy because this is right where we are, right? So that's the first problem on the balance of payment. It could be a surplus. So a surplus, in as much as it could sound like a good thing, we always prefer things to be balanced. We always prefer things to be balanced. You see, we always prefer things to be balanced. So that's problem number one. Problem number two, we could have a deficit. So a deficit is pretty much the opposite of what we were talking about there. Current account deficit. So this is where we were, or this is actually where we are, sorry. So where our imports exceed our exports. So this is right where we are. What's the effect of that? Currency depreciation. So it's the opposite of that now. So a chronic current account deficit. So it means there is low demand for our products, right? Basically, can lead to a depreciation in the currency, right? Why so? Because nobody wants our currency, so the value of our currency is going to go down. So while this can make exports cheaper, it can also lead to higher costs of imported goods and potentially fueling inflation. So if we are obviously having a current account deficit because we are relying quite a lot on imports. So what happens now when our currency depreciates while we are relying on imports? Then it means we are basically going to be having quite a lot of inflation in the country, right? Trade imbalances. So a deficit can indicate that a country is relying heavily on imports, which might affect domestic industries. So over time, this can lead to loss of competitiveness in certain sectors, right? Depletion of foreign reserves. So I did say I want to include this there up on top. I just don't know how I missed that there. I'll just fetch it from the previous notes. So obviously, we need to finance that current account deficit. So a country might need to use foreign exchange reserves. So if it's not going to be compensated by capital inflows, then the money is going to come up. The finances are going to deplete. So there's basically going to be a depletion on the foreign reserves. So where are these foreign reserves held? So they are obviously held with the South African Reserve Bank, right? So this can deplete a country's external reserves, leaving it vulnerable to economic shocks. So big economies like China, like Russia, they always have huge stocks of foreign reserves. China, I think outside of the United States, has most of the US dollars, and they are in China, you see. But again, think of other countries like in the Middle East there, the countries selling gold. There's a lot of United States dollars there. I think even there by Muammar Gaddafi's country, Libya, there's quite a lot of United States dollars there. Right? So ideally, you must have a huge stock of, like currently the United States dollar, right? You must have quite a lot of that. And then foreign debt accumulation. So a chronic current account deficit can also result in a build-up of foreign debt. So the country might borrow to finance its imports. And if the deficit persists, servicing the debt can be challenging. Then, of course, we are economically vulnerable, definitely, because we are relying on foreign goods. All right. And then the last one, a deficit in the capital account. So which is the financial account. So under what circumstances does that occur? So it occurs when there are more outflows than inflows. Right? So luckily we don't really fall under this category, but some countries do. Right? So while some level of capital outflow might be normal, a sustained deficit can lead to problems. Right? So remember what you have there under the financial account, direct investment. So imagine direct investment going out of the country, people taking their money out of our financial markets. That's really bad. Right? Depreciation pressure, definitely, right? Exactly what we are describing. A lot of people taking out their monies there definitely leads to a depreciation pressure. And then reduced investment, definitely this is pretty obvious. And then lack of confidence. So it's usually due to a lack of confidence when this happens, right? And lack of confidence generally lead to more lack of confidence. So it becomes a cycle, right? Domestic savings shortfall, and then vulnerability to capital fluctuations. That's what you definitely get there. All right. And I don't know if we have any questions regarding this here. Additions, hopefully subtractions. Right, I'm gonna stop the recording so I can allow you to be free to ask any questions.